Hi, my name is Darren Joseph from HTJ.tax. We're the team that seeks to demystify this sometimes confusing world of international tax and the privilege of having a deep conversation with Mark. Mark, can you please introduce yourself?
I'm Mark Morris. I'm based in Switzerland. I've been here for about 26 years. I've specialized in automatic exchange of information, which originally was the EU Commission's EU Savings Tax Directive. And that went on until about 2014, and they scrapped that and they adopted the OECD's FATCA made into CRS.
So can you share with us what it is you do professionally?
Primarily, I provide custodial services for trusts to hold underlying entities or partnerships or unincorporated funds. So what I do is I provide the administration services for the custodial. I don't do the actual custody. And later on, I'll explain what administration services for custodial is. And I'm an expert in CRS and CARF, and I certainly know the intricate differences between CARF and CRS. We'll get into that in a later question, okay? I've published over 600 articles on LinkedIn, and I'm still writing about 10 a week. And I don't see other people covering 99% of the topics on CRS that I cover.
Okay, thank you. Let's talk about FATCA. What are your thoughts on FATCA?
Now, there's a very famous case that the U.S. Senate Finance Committee published a 40-page report called the Shell Bank Loophole. Now, they're using wrong terminology, but the principle is the same. So there was this Bill Brockman in the States, a very wealthy investor from New York, and he used investment entities, explain what investment entities is now, and he simply didn't report on his $3 billion worth of income. And then somebody ratted out on him, whistle blew, and he was going to be found guilty of $2.7 billion, the largest evasion of tax by an individual. He was going to get incarcerated and fined millions, but then he keeled over a golf course. That's the end of that case.
Wow. Okay.
So the basics of automatic exchange of information, whether it's FATCA, CRS, is who's responsible for reporting you. It's a financial institution. So FATCA came up with 4 financial institutions. Actually, there's the FATCA regulations and the FATCA IGA, but I'll just stick to the IGA because CRS kind of copies the IGA. There are 4 types of financial institutions, and they are the ones that are responsible to report on you. So the first one is depository institutions, which are generally banks. So if you've got a bank account, they're going to report. The next one is custodial institutions, and that's usually like a broker holding your shares, your stocks, okay? The third type of financial institution is an insurance company. They call it specified insurance company. And those are the ones that issue what is private placement life insurance or investment-linked insurance, etc. They would report on your policy if you're the policyholder. And then the fourth one, which was strange, they're called investment entity. It's simply a corporation or a partnership or a fund or a trust that has financial assets and is professionally managed. Professionally managed means any percentage, even 1 cent, 1 penny, being professionally managed by another financial institution, then that is an investment entity. So the biggest loophole is if you're an investment entity, you're a company where your funds are being professionally managed, or 1 cent of that is being professionally managed, the bank doesn't report on your company. You're supposed to report, or the director. And there's no checking if you report or not. All you got to do is when you're a financial institution, you register with the IRS for FATCA, and you get what is called a GIN, a Global Identification Intermediary Number. And then the bank just steps back and says, okay, now it's up to you. And it's kind of simple that you just don't report. You report, there's nobody that's reportable, or there's no value for reportable. And nobody's checking that. And the way it should be attacked is if you got an investment entity and you don't report anything for FATCA, that means you don't have a US beneficial owner, and you don't have a CRS person, and you're still reporting there's nobody, that's the height of fishiness, okay? And the country where you are reporting from, because everybody's got to report from the country where that entity is located, where it's managed, where it's corporate, that country should instigate a audit and say, please explain why you're not reporting anybody. But for instance, this Bill Brockman, 90% of his companies were registered in Nevis, and the other 10% in Bermuda. But the banks were Swiss banks, 2 Swiss banks.
Right.
Mid-sized banks, not the biggest. The Swiss banks, they said, you've given us a global identification number, which proves that you're an investment entity. It's not up to us to report. And he was the director. He just simply said, I have nobody to report on. And Nevis and Bermuda should have said, wait a minute, you're not reporting on anybody. Who's behind this? But CRS, FATCA doesn't oblige any country to do this. And countries are not really doing audits of financial institutions. They are of banks, of insurance, something big. But all these hundreds of thousands or millions of little companies, they're not auditing those. They said they would. They send out some scare letters, but they don't have the personnel. And why should they? They don't get 1 cent income by saying who's behind what's their motivation?
I'm thinking their motivation is to not be locked out, or not to get on the wrong side of the United States. Remembering Switzerland as a case study in what happens if you get on the wrong side of the US, right? Shouldn't that be an incentive?
No, they're following the law. If the law is weak, it's up to the Senate to start saying things like, okay.
So going back to it, if you have an investment entity and you have a gym, and I know you have like model 1, model 2. So one model requires you to report directly to the US, and the other model requires that you go via your responsible authority domestically.
Yeah.
Often enough, the reportable authority domestically, once they know that you have a gym and they don't see a report on an annual basis, they'll prompt you, right? And
there is a report, except it's a null report.
Right.
Before, when they first started, they said if you don't have a reportable person, don't report. But they've all kind of changed to say you must submit a report, but it's a drop down and you say either I have no to report or I don't have anybody to report. Then it's not up to them to ask questions why.
Okay, I see. So in the case of just outright dishonesty, it's hard to catch that. I see what you mean.
But they're dishonest in the first place, aren't they?
Yeah.
I don't think that's a mitigating factor.
All right.